Hey friends, the Straits Times Index, our very own STI, has been on fire, smashing all-time highs. After being stuck in a lost decade for so long, it took a whopping 18 years to finally climb back to its 2007 peak. And now, it's officially back. Stay with me till the end because we're breaking it down. What exactly is the STI Index? Why it's flying so high right now? What might affect it going forward? And most importantly, how you can invest in it for long-term, steady, passive income. If you love videos that make investing easy and Singaporean-friendly, smash that like button so more Singaporeans can watch, and subscribe to Wealth for You for more smart money tips every week. Disclaimer: this video is for educational and entertainment purposes only and does not constitute investment advice. All investments carry risk, and past performance is not a guarantee of future results. Always do your own research before making any financial decisions. Chapter 1. What is the STI Index? Imagine you could check Singapore's economic health with just one number, kind of like taking the nation's temperature. That's exactly what the STI, or Straits Times Index, does. It's our stock market's report card, made up of the 30 biggest and most actively traded companies in Singapore. These are the heavyweights, the brands and businesses that shape our economy every day. You'll definitely recognize the names: DBS, OCBC, UOB, our three banking giants. Singtel, the telco that probably powers the internet you're using to watch this. CapitaLand, Mapletree, property powerhouses, and Singapore Airlines, our pride in the skies. When you see the STI move up or down, you're not just looking at a chart. You're looking at the heartbeat of Singapore's top companies, all rolled into one single number. Chapter 2. Why did STI hit all-time highs recently? All right, let's spill the kopi. From as early as the end of last year, analysts were already predicting that the STI rally was coming. Some were bold enough to forecast 4,000 in 2025. And now, it's starting to look less like wishful thinking and more like reality. So, what's been fueling this surge? First, bank power. Our three banking giants, which make up nearly half the STI, have been on fire. DBS soared 23% to record highs, OCBC climbed 12%, and UOB rose 10%. This was driven by higher-for-longer interest rates, fattening net interest margins, and a wave of wealthy clients setting up family offices here, pouring more money into private banking and wealth management. Second, we've got a broad-based rally. This time, it's not just the banks carrying the load. ST Engineering rocketed 80%, riding a boom in defense and aerospace contracts. Hong Kong Land surged 85% after launching share buybacks and pivoting strategy. SGX leapt 60%. Even Singtel, once thought to be a boring telco, bounced 33% under a bold turnaround plan from its new CEO. Third, corporate makeovers. Many STI companies have been hitting the reset button. They're going asset light, unlocking value from non-core assets, and rewarding shareholders with dividends and buybacks. Fourth, Singapore as a safe haven. Low unemployment, political stability, and pro-business policies continue to draw global capital into our markets. And fifth, MAS market boost. And here's the kicker. Our monetary authority is putting 5 billion Singapore dollars on the table to revitalize the local stock market, attracting institutional investors, encouraging more high-quality IPOs, and boosting liquidity. Put all that together and you've got the perfect storm for the STI to break out of its 18-year slumber and hit fresh all-time highs. Chapter 3. What could affect STI going forward? Of course, it's not all sunshine and kaya toast. The STI may be at record highs now, but you know, markets are like the tides. They move in and out, and sometimes they splash your kopi. First up, Interest rates. When rates start to come down, REITs could finally breathe easier. Borrowing costs drop, valuations improve. But for banks, lower rates might mean slimmer margins, so their earnings could soften a bit. Next, the global economy. Singapore is small and open, so big events overseas, like a US-China trade war flaring up again, can hit our exports, manufacturing, and even shipping sectors. Then there's corporate earnings. As long as Singapore's top companies keep delivering strong results, investor confidence stays high. A bad earnings season, though, can quickly take the wind out of the sails. And finally, the global cash mountain. About $7 trillion parked in money market funds. If interest rates fall and yields there shrink, some of that money could start flowing into stocks, giving markets, including the STI, a boost. So, moral of the story? The STI will have its ups and downs, but over the long run, its direction will be shaped by a mix of our local fundamentals and the mood of global markets. Chapter 4. The STI ETF and how to invest in it. Now, if you want to invest in the STI without going through the trouble of buying 30 individual stocks one by one, meet the SPDR STI ETF, ticker ES3. Think of it as a basket containing all 30 STI companies. With just one trade, you instantly own a slice of DBS, OCBC, UOB, Singtel, CapitaLand, SGX, ST Engineering, and many more. Launched in 2002, this ETF is beginner-friendly, low-cost, about 0.28% per year, and pays dividends twice a year. Right now, it's yielding around 4.7%, making it one of the simplest ways to get exposure to Singapore's economy while collecting passive income. So, how should a Singapore income investor approach it? This is where we put the Kopi money strategy into play. If you've got a lump sum and the market suddenly drops, say during a recession or global panic, that's your golden moment to scoop up STI ETF units at discount prices. Buying low means more units for your money, and when markets recover, you get both capital gains and dividends. But let's be real, market crashes don't happen every year. Waiting forever for the perfect moment often means you don't invest at all. That's why, for most people, the smarter and more stress-free approach is dollar cost averaging, or DCA. Invest a fixed amount every month or quarter. When prices are low, your budget buys more units. When prices are high, you automatically buy fewer units. Over time, this smooths out your buying price and takes the emotion out of investing. And here's the best part. You can start with as little as $100 a month using regular savings plans like POSB Invest Saver, OCBC Blue Chip Plan, or Poem's Share Builder Plan. Remember, the goal isn't just to be asset-rich on paper. $1 million property doesn't feed you unless you sell it or rent it out. The real goal is to be cash flow rich, having income flowing in whether you're working, traveling, or enjoying retirement. The STI ETF can help you build that steady stream of dividends, backed by 30 of Singapore's strongest and most established companies. That's how you make your Kopi money work for you, quietly, steadily, and for the long haul. Chapter 5. Banks plus REITs for Singapore investors. Now, if you're a Singapore income investor, the STI ETF is a fantastic one-stop option. But you can also build your own dividend portfolio with some of Singapore's most reliable income stocks. For the banking side, DBS and OCBC are two of my top picks. Both have strong balance sheets, consistent dividend growth, and benefit directly from Singapore's position as a regional financial hub. DBS in particular has been paying special dividends in recent years, and OCBC has been steadily raising its payout while expanding its wealth management business. On the REIT side, CapitaLand Integrated Commercial Trust, or CICT, is one of the bluest of blue chips. It owns prime malls and office buildings like Raffles City, Plaza Singapura, and Asia Square, properties that remain in high demand even during slower economic periods. Its dividend yield is attractive, and as interest rates ease, REITs like CICT could see both yield support and potential capital gains. You can also look at other established, large-cap REITs such as Ascendas REIT, with a diversified portfolio of industrial, business park, and logistics properties across Singapore, Australia, the US, and Europe. There's also CapitaLand REIT, focused on data centers, which is a growing digital infrastructure play, and Mapletree Logistics Trust, or MLT, with a broad network of logistics properties across the region. These stocks and REITs offer a combination of stable dividends and long-term growth potential, and for many Singapore investors, they form the backbone of a cash flow-rich portfolio. The key is balance. Mix the stability of banks with the yield of REITs, and you'll have a diversified income engine that keeps running in different market conditions. Final thoughts. So, is the STI perfect? No. Is it going to give you the same fireworks as US tech stocks? Also no. But here's the thing. It's stable, it pays well, and it's built on companies you already know, use, and trust every single day. This isn't about chasing the next big hype. It's about building a foundation that lasts. The STI is like the tortoise in the old fable. Not flashy, not sprinting ahead, but steady, dependable, and still crossing the finish line with money in your pocket. And here's the magic. Those dividends don't just make you richer on paper. They can fund your life. Because financial independence isn't about saying, I own $1 million worth of assets. It's about saying, I have enough income coming in every month to live the life I want without worrying about my next paycheck. That's what being cash flow rich means. And the STI ETF, along with strong dividend-paying banks like DBS and OCBC, plus blue-chip REITs such as CICT and Ascendas REIT, can all be part of the toolkit to get you there. Slow, steady, predictable, and powerful over time. So if you enjoyed this, tap that like button so more Singaporeans can watch, subscribe to Wealth for You, and share this with someone who needs to start investing for passive income. Stay steady, keep collecting those dividends, and I'll see you in the next video. Majalah Singapura.